This podcast is for informational purposes only and does not constitute legal, tax, investment, financial, or other advice. It is not intended to cause or induce breach of an existing agency agreement.
Hello? 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 This is the Vancouver
Commercial
Real Estate Podcast.
And welcome back to the Vancouver Commercial Real Estate Podcast. I'm Adam Scalina, and I'm here with Rod MacKay. How you doing, Rod?
Doing fantastic. How are you, Adam?
Not too bad, not too bad. So it was actually you and Seamus Bailey this week doing the interview with guest Nigel Clark from BFL Canada. Who's Nigel Clark?
So Nigel Clark, he works in the insurance industry, specifically in construction and commercial real estate. Like you said, he's with BFL Canada, and they're one of the biggest companies out there. So he's got lots of experience and had a lot of great things to say.
Nice. And so what really, when we're thinking about insurance right now, like obviously we're in an environment where interest rates are increasing. We're trying to get inflation under control. The market has, at least in residential, changed. I'm guessing there's been some changes in the commercial market, but what are the big things that, like, why bring on someone in insurance at this moment in the market?
Well, I think insurance is something that, not a lot of people understand all that well, but the reality is that in every single real estate transaction, insurance is involved. No matter what type of transaction, how big or how small, insurance has a factor. And like you said, we're dealing with inflation, rising interest rates. We've got supply chain issues. And then, from talking to Nigel, it sounded like there were a lot of parallels to the insurance market from the commercial market.
That's great. And so it's you and Seamus. You guys figured out the equipment okay?
We figured out the equipment, yeah. So, Corey was on holiday. I think he was riding some roller coasters down in Disneyland in California. And then sounded like you and Matt had a little golf tournament there. So Seamus and I took over. But, I think after the listeners hear this episode, you guys might be out of a job. So I appreciate you guys giving us the chance.
Well, potentially backed by popular demand. Rod and Seamus show coming soon. But why don't we cut to our interview with Nigel Clark?
Yeah, it's a great one. Let's do it.
This week's episode is brought to you by our great friends at Impact Commercial Group.
Really enjoy working with Impact Commercial. And we should say Al and his team can basically do anything when it comes to lending.
Anything when it comes to under the commercial umbrella. You're building a building and development, we got you covered. You're buying land, we'll make that happen for you. You're investing in a property or multifamily building, check. Owner-occupiers looking to acquire their own space, double check. Anything commercial financing you need, Impact Commercial is your go-to.
ImpactCommercial.ca. And we should say over 50 years of combined experience. So trust these guys. They're the right fit.
Best in the business, in my opinion.
Okay, so we're here with Nigel Clark, the Senior Vice President of Construction and Commercial Real Estate at BFL Canada, one of the largest risk management, insurance brokerage, and benefits consulting firms in Canada. How you doing, Nigel?
I'm doing great, guys. How are you?
Doing well, thanks.
Yeah, pretty good. Can't complain.
So we'll start off. Can you tell us a little bit about yourself?
Yeah. So as you eloquently mentioned, I'm working in the construction and commercial real estate team in BFL's Vancouver office. Within our immediate team, we're about 50 people strong between our insurance, surety, professional liability services, and then the other main divisions within our office, which are realty, like strata real estate, as well as general corporate. Makes up, general business, like commercial business, as well as specialty mining and forestry. So we're a big firm. Me personally, I've been here for about 12 years now. I live in East Vancouver, just moved last year. I've got a wife and 2 young daughters that keep me pretty busy outside of this this job I'm in.
Awesome. Yeah. So we're so glad that you joined us today because insurance is an industry that not a lot of people know too much about unless they're intimately involved in the industry. But it's an aspect of commercial real estate that we deal with in every single transaction. There's tenants insurance, landlords insurance, mortgage insurance, strata insurance, construction insurance, and it seems like the list goes on. So we'll dive right into it. I'll pass it over to Seamus Bailey here.
Yeah, so you kind of touched on the fact that you're in commercial real estate and construction insurance, and the breadth of your company's coverage is pretty wide. But you yourself, is there any kind of additional specialization within that, or is it really just cover all of commercial real estate and construction insurance?
Yeah, those two between the both of them keep us pretty busy,
Mm-hmm.
and there's a lot of intricacies between those two types of coverages as well. So it really was born out of the fact that we were primarily a construction team when this team formed back in the Vancouver office, formed in 2004. But a lot of our clients, as you know, retain their assets. They have asset portfolios. And so we kind of manage the two of them together in sync, the construction and their operating assets.
Yeah, makes sense. We are also wondering, so we've been, as most people would know if they're watching the news, we've been experiencing inflation and interest rates being on the rise and volatile construction costs. How is this affecting your life in the insurance world and your job?
Yeah, good question. I mean, the insurance business is no different than any other business right now in terms of its exposure to, the inflation issue and rising costs around construction. So we're not insulated from that. It is certainly prevalent in my day-to-day at the moment, certainly around when we're talking about values and insured values. So I just went through a large commercial real estate schedule renewal that, the insurers right now, so let's say the main property insurers, so the property insurance carriers, which are, the guys that are responding to the earthquake, the floods, the fires, that make up the lion's share of a premium that our clients are paying for. Their first comment kind of coming into the renewal process is they want to look at values. So they want to make sure that our insureds, our clients, are updating their replacement values to reflect the increased cost of construction and address inflation. So that's kind of a battle we're having right at the start of a renewal process. Now, some insureds have, different ways of valuing their replacement cost. Like some have certain efficiencies that allow them to build cheaper than others. And so there's no one particular formula that we arrive at. It's a sort of 3 or 4 pronged approach when we're arriving at a value that everyone is happy with, the insurers and our clients. And so certainly, yeah, that those two topics are kind of front and center. And you've got insurers that have costs of their own that are going up. And so they're looking to recoup those, like just running an insurance company and the overhead associated with that is expensive. And so they are looking for rate just to cover that part. So you've kind of got, 2 prongs coming at our clients right now with respect to those in terms of what impact that's having on their premium spends.
Yeah, so it sounds like, from an insurance perspective, what's happening globally has a huge impact on it. If I'm in BC and I've got a strata building, it sounds like, my premiums could potentially be affected by bushfires in Australia or floods in China. Is that true? And what other factors are driving the rising costs here?
Yeah, it is true to an extent. Absolutely. I mean, these insurers are multinational entities with reinsurance treaties that all bleed up into, a handful of companies that are essentially insuring, assets and everything in between around the world. So when, say, a Munich Re gets, hit with a massive wildfire in California or a flood in Florida, or hurricane in Florida, say, I mean, that has ripple effects on obviously their profitability, but then, their insureds, which are the sort of the retail insurers that we are working with. So if the reinsurance costs are getting hit, they're going up, those are going to bleed down to the prices that we pay as, the customer. And so there's no question that there is a ripple effect with global disasters on that scale. And then, you can break it down further into more of a micro sort of environment in Canada and the US, especially recently in the West Coast, where we've experienced, the flooding, in the Fraser Valley last year, the wildfires, that we've had in the Okanagan in the last couple of years. And then certainly in California, that is a major factor because these are a lot of the same insurers that we are working with that are paying out these claims.
Yeah, definitely. So I think Seamus touched on it a little bit, talking about rising interest rates, inflation, construction costs, supply chain issues. And a lot of this, I feel like, has stemmed either directly or indirectly from COVID-19. So in terms of insurance policies, are you seeing any policies being pivoted, if there's interruptions in business that are unavoidable?
Yeah, so COVID had a huge impact on our, the insurer side of our business in terms of where their appetites went at pre and post COVID. They may have been aggressive in certain sectors and COVID hit and they just turned the taps off. And there was a general approach in the height of COVID where insurers weren't writing any new business. And they certainly weren't taking on risks or classes of risk that are not as profitable or more difficult. And you could put residential real estate into that category. And so COVID compounded what was a very difficult insurance market. And that's when you heard, remember, when it starts making the news, when I see strata insurance premiums making, the local news, or it's in the Vancouver Sun, it was kind of that period where COVID exacerbated the issues that were already there in terms of where rates were going. So it's certainly leveled off now. It's nowhere near where it was before in terms of what the insurers' appetites are and what they were writing it price wise for at that time. But there's more appetite back in the market. There's a bit more capacity. We have a bit more flexibility with certain risks that we may not have had last year or the year before that.
Yeah, when to go back a second, you mentioned that during the peak of COVID-19 that you wouldn't be writing new business or kind of avoiding more risky assets going forwards. Has there ever been another time or that you can think of where insurance has kind of just halted on things, or is COVID-19 truly so unprecedented that it was the kind of first instance of, I guess, actuarial scientists kind of taking a back seat for a second?
Yeah, no, I should say that we weren't right. It wasn't that we weren't writing new business, is that the insurers just turned the taps off and looking at anything new. So they met their obligations in the contract and the insuring agreement to stay on risk, but they were super stringent about, sort of the renewal process, what they would take on and what they wouldn't. I would say from that perspective, COVID was something we had never been a part of anything like that. So it was very new to us. And it made doing the day-to-day of our business that much more difficult. And the frustrating part of this is that communicable disease, which is how insurers classify COVID or any other type of, pandemic event, is an exclusion on most sort of general property and casualty policies. So it's not like they were paying out a boatload of claims. They were getting dragged into claims, but whether those get paid out or not, ultimately will be the decision of the courts. So it was more just kind of, or it felt like a bit of a general response of we just don't know what's going on. We're worried. We're just turning the taps off and we're going to see what happens. Right. Not unlike the interest rate environment right now and kind of in your guys' space where people are just maybe stepping back and reevaluating and just seeing where things land in the next couple of months.
Yeah, so on that same vein, we've heard terms. Of course, we don't know exactly what they mean. So we ask, what does it mean exactly in insurance to be in a soft market or hard market? And where are we now? And perhaps even where are we headed?
Yeah, no, good questions. So the soft market is really characterized as a market that has a lot of capacity. There's a lot of insurers fighting for that same business. And so what that does is, reduce pricing because you've got more supply. And you get a lot more in terms of, deductibles, favorable deductibles and extensions and, additional coverages because you have that flexibility. So it's a market that we were in a soft market for, I think well over a decade prior to 2019. I mean, it was already turning well before COVID, but we were in what was called, a soft market. And for us as sort of brokers in that space, it's a nicer place to be in because you're able to deliver your clients multiple options at usually, reduced pricing, and everything is good news, right? The hard market is the exact opposite of that. It's when you've got very finite amount of capacity for the same level of demand, and that obviously would lead to increased rates, more restrictive coverages, higher deductibles. That is the market that we are in now, and it was certainly a tough transition being in this business where you were delivering some bad news and having hard conversations with your clients about where their insurance program was going and where it is. I would say that now we're kind of, my observations are that just in the last 6 months, we have seen more capacity creep back in, which is softening this hard market. We're not in a soft market by any means, but we're certainly in a softer hard market.
And we're wondering as well, so in commercial real estate, I'm sure we deal with various asset classes, be it multifamily, retail, office, etc. Can you touch on how the insurance process or policies differ between these asset classes? Perhaps some are more insurable or less. I'm not sure.
Yeah, so at the bare bones of it, they all insure the same thing no matter what. We're talking about the basics here. We're property and liability, which is 90% of what a premium makes up. It's covering the same things, right? It doesn't matter what class it is.
Mm-hmm.
So I'll just run through it. So property, you've got your coverage for your building, for earthquake, for flood, for water damage, for fire, for theft, vandalism, etc. And then on the liability side, you have coverage for against third-party claims of bodily injury or property damage arising from your ownership or operations of your building. Okay, so between those two, they make up the lion's share of what you're spending in premium. Now, in terms of desirability with insurers certainly prefer commercial and office type risk over residential. So they view residential habitational type risk as in a completely different lens than commercial. Now, that's only because it just has a higher propensity, that is residential, for claims. People are living in it. People have different ways of living, do different things. There's just more claims in that space than there is in commercial real estate.
Mm-hmm.
So it's between those two, I would say, the process is a bit easier, for lack of a better term, with the commercial office sort of, retail landscape for us.
Yeah, so just to piggyback on that, I mean, and we talked about it earlier too, the strata insurance policies for these residential buildings, I think it was kind of midway to late 2020, even going to 2021. It was all over the news just talking about how these policies were skyrocketing. Is that still happening, or is it because we're kind of in a hard market that's a soft hard market and it's trending down? Is that leveling out, or where are we at with those strata policies?
Yeah, so I'll qualify this that it is not exactly my division, but I know enough about it to speak to what was going on at that time. There was sort of a confluence of events that had happened to get it to where it was in that 2019, early 2020 period. So in BC and most of Canada, you have 99% of strata insurance policies placed via 3 or 4 programs, right? Now, those programs have 20, 30 insurers on it, from domestic to international to, global insurers in Bermuda, in Asia, and of course in London. You pretty much proportionately, you have shares among all those insurers that take a piece of the program. So the program is the volume in which, how many buildings you have in this program, the insurers will take their proportionate share. So they're not necessarily evaluating each risk on its own. It's like part of large schedules, like from property managers, and it goes into this program. And say you have say for example, a Zurich who takes 20%, and then you have Lloyd's of London that takes 10% share, and so they take 20 and 10% of the whole program. So what happened in 2019, 2020, out of these like 30 or so insurers who all play on this program, 2 or 3 that had big shares got out of the market. They pulled out, or they said, if we continue to stay on, we're going to need to see massive rate increases and deductible changes. Now, this was all driven by losses. So we have a lot of we have a large strata program. So we have a lot of data in this space. And, on average, the years leading up to 2019, let's say the 4 years prior to that, for every dollar that strata insurers were taking in premium, they were paying out about $4 in claims. And so that can only go on so long before they need to make changes. And what happened, and the claims, I should qualify, were mainly water damage claims. So they are, the number one frequency type event in the residential real estate space is water damage. So that's pipes bursting, sprinklers going. They're very expensive claims, particularly when they're in high rises. And they were happening at such a frequency for these insurers that they were just paying out way, way more than they were bringing in. So we started to see those changes. Insurers pulled out of these programs, got out of like residential completely in North America. And so again, that's like that hard market, that capacity gets taken out, that leaves who's left. And those insurers that were left were like, okay, if I'm staying in or taking more, I'm going to need more rate. I'm going to need more deductible. And then you had, things like COVID and, other things that were happening at that time that just threw gas on the situation. And so that's when it started to get into the press, where you had these strata buildings that don't carry large contingencies, with senior citizens or, people that, aren't necessarily able to just fit a $10,000 assessment on insurance, make, rightfully so, like, this isn't right. Something's going on. And so that's kind of why things got to where they got to then. I can tell you now that it's certainly plateaued and it's starting to come down a bit as the profitability in this space has, come back. Insurers are again, willing to play as long, and the deductibles are still high or higher for certain perils, as we go. So water damage may carry a much higher deductible than like a fire deductible. But that sort of adjustment has now brought profitability back into the space, into these programs on a national level. And so we are seeing a leveling off or reduction in prices.
Wow, that's a great answer for somebody that says they don't specialize in this. Sure sounds like you know it inside and out. So let's jump over to construction though. So if this gets said too much, I mean, I wonder how many times on the Vancouver Commercial Real Estate Podcast we've said inflation, rising interest rates, and supply chain issues. But with all of this, is it with the rising costs, do insurers see it as more risky to give insurance to developers, or how is that segment of the market playing out?
Yeah, so insurers are looking at sort of construction insurance. So a property, in the construction space, if you take out a property policy for your project, it's called the course of construction policy. And that's meant to cover, physical damage to the project from start to finish. So right from when excavation starts to handover, whether it be retained or sold off as strata. This environment has, again, like similar to what I was mentioning on the commercial side, had insurers maybe not always question, but dig down a bit more on the pro formas, because these policies are based on the estimated construction costs, right? Because as you know, these projects that, before all of this, construction has there's a lot, you need a bit of bandwidth for changes throughout the term of a project. And so if the estimated project values are, noticeably lower for something, maybe a similar project that our insurers have done on another file, they may come back to us. but it's kind of less of an issue because ultimately they're adjusted at the end of the project anyways. So barring like a very material change in values, you say to the insurer, you go, okay, I estimate my project to be at 50 million. At the end of the term, we're at 60 million. Our clients would just pay the difference on the rate that was negotiated at the start of the term for that $10 million difference. And if they come in lower, which isn't typically the case now, they would get a return premium for that difference. So those construction policies are fluid, to adapt to the realities of a project. Where we are seeing it most sort of evidently is kind of where the extensions and bells and whistles on course of construction policies are in terms of, you have like a margin clause or an escalation clause, which we used to be able to get done at 20% all day long. So that means that if we had a total loss and we had a $50 million project and we had a total loss with a $20 million escalation clause, well, we could be entitled to $10 extra million of limit, in the event that we were short that. So those types of clauses have certainly been reined in, and they're kind of down at the 10% level. And again, if our insurers see a big discrepancy on estimated cost per square foot from what they deem as, maybe the norm for the time, we fight that battle all day. But it's certainly something that's more front of mind for sure.
On that same note, I feel compelled to ask is, since it's based off estimated construction cost and pro formas, is a developer's track record taken into account when, creating these insurance policies? Because, you'll hear around the streets that XYZ developer has built 3 projects in a row that had, a flood. Is that something that's taken into an account on your end, or do you kind of view all developers as one and the same and just kind of evaluate the pro forma?
Yeah, so we work with a lot of developers, and our approach is we package them up individually into the marketplace. And you're basically, it's like you're developing a sort of a package to promote what this project is and who's building it to achieve the best possible result for your clients. If a developer or, a contractor has had a run of claims, it certainly comes up, and it's usually the insurers that have paid those claims, obviously. So they want to have a conversation about that, but often it's addressed by maybe tweaking some deductibles, or maybe that insurer doesn't participate in that project or scales down the amount they're going to put up. But it's a pretty rare case in terms of like the developers that we're working with have good track records. Like nothing's perfect, but insurers, what they look for is frequency and severity. And if they have both of those, that's their red flag. And that's when you have to engage with them on conversations around this particular builder, whether it be developer or contractor or CM, and make adjustments and pivot as you need to. But it doesn't often result in a, hey, we're not going to write this. It's pretty uncommon because, there's so many different participants on a project that it's hard to pin it on any one entity or company or trade or whoever. So it's just our job to make sure that we're communicating that properly to the insurers.
Right. And then we kind of already touched on this, but at the risk of being redundant, there's a lot of talk of us heading into an impending recession here for, an undefined amount of time. How would this affect the insurance market?
That is a good question. I think, if you see a slowdown, on all sides of the economy, that's going to make insurers more hungry to continue growth, right? So you could see scenarios where that's actually going to improve, our current market of being sort of at the tail end of a hard market, where insurers are looking for growth because they're not seeing the same volume that they were. And so if for that to, be achievable, they have to get a little bit more aggressive than they have been in the last couple of years. So that's kind of my rose-colored view on what a recession could mean for the insurance side of things. And that's already happening in tandem with a sort of softening in the market. But that's my expectation because ultimately these companies all want to grow, right? And they've had the ability in the last couple of years, given sort of, the state of certainly in the construction side, the volume that was coming into them, where they could say no to a bunch of things and be okay and still meet their budgets. and still meet their KPIs. That's not going to be the case if things really slow down here and they're fighting for some business. And if they're fighting for business, that's good for us and that's good for our clients.
Yeah, that was going to be my follow-up question. So as insurance brokers, you have almost an inverse relationship with a recession than a lot of like ourselves, for one, or a lot of other industries who would view recession as a really bad time to be doing the job. In some ways, it's kind of nice as a insurance broker to be able to bring good news to your clients.
Yeah, it's obviously we prefer not to be in a recessionary environment, but if it's making our clients they deal with what they deal with, and insurance makes up a very small part of their day. So if we can be a small part of good news in in other eyes, day of things that maybe aren't working out as much as they hope, and that's great. But we're not sheltered from the challenges of a recessionary environment as well. So we're just gonna have to wait and see how things kind of pan out here.
All right. Well, that was an extremely informative talk. I really appreciate the time, Nigel. Before we head into the six pack, I know you were joking around a little bit earlier when we spoke about not wanting to bore the listeners, but I think you did a phenomenal job and there's lots of great information in there. But do you have any fascinating stories that you can share with us from the insurance world? Anything that sticks out?
Well, I'll share something with you guys that kind of is in line with what we're talking about, the escalation of costs. We had a large project out east that suffered a major fire. So the project started, say, in 2018, right? So the policy was in place. It was a large wood frame project, and it went up in flames kind of near the end, right at the worst time for insurers, because when it's almost finished, that's when those construction insurers are most exposed, right? It went up, and it was a total loss. And the values from, when they had estimated those costs to what they needed now in today's environment to replace that same building, there ended up being like a $30 million difference.
Wow.
Right. So, that is a very unique situation. And there were some factors around that particular area in the country and what was going on at the time. But it's really like a sort of, jaw-dropping example of where these costs have gone. Now, the insured, he's going to be taken care of. He'll be fine. But the insurers were just like, it caused, like we were saying before, it caused them to kind of put a microscope under what values are being reported now. And I should say a lot of it is also, you're going to have lenders involved, as you guys know, that will require certain limits, and they've underwritten the project. So we don't really run into a big problem on values, but certainly the lenders have a say. You've got sort of the quantity surveyors having a say, and you have the insurers having a say. So around between everybody, and they are of course on insurance having a say, that the values are kind of coming in where they should be. But that was certainly an example that it really sort of hit it home on sort of where things are costing now versus a few years back.
Yeah, that's a wild one, and really puts things into perspective. So thanks for sharing that with us. If you've got a little bit more time, we've got a six-pack of lighthearted questions we'd like to ask you if you've got the time.
Hit me with them.
The six pack is powered by our great friends over at Red Point Law.
Oh, the guys at Red Point Law are fantastic, Corey.
For all your legal needs when it comes to commercial real estate, visit them at redpointlaw.ca.
All right. So, favorite vacation spot?
Okay, since kids, I would say Hawaii. Anywhere in Hawaii.
Excellent. That's a good choice.
Which island, though?
I actually like Big Island the most.
Me too.
Yeah, nice. You get a bit of everything there.
Yeah, agreed. Okay, number 2, favorite band or bands, if you so choose.
Oh, nice. I get 2. I'm going to limit this to 80s and 90s.
Nice.
Metallica and Guns N' Roses.
All right. So I said lighthearted questions here. So we're going to have to say, I think Corey Wright wrote this one. I don't know if he understands what lighthearted means, but what would be your final meal if you were on death row?
So I think I listened to the episode where Corey was the guest, and he had said, he was like, bang on what I would do, or at least there were some similar themes. I keep it simple. First of all, I wonder why I'm on death row, but besides that, 2 cheeseburger meal with a filet of fish and hot mustard sauce. That's it. And maybe a chocolate mousse for dessert.
Love it.
What show are you currently watching on Netflix, if any?
Peaky Blinders.
Peaky
Peaky
Blinders.
Good one. That's a good one. Favorite restaurant or bar?
So restaurant, I would say Elisa in Yaletown.
Nice.
Yeah, see, that's out of my budget.
I only go when insurers take me, so it's nice. It's a special spot though, and it's really turned me on to being more of a steak eater. So, and bar, I would have to say before the Blackbird, and we're downtown, so spent a lot of time there. So before the Blackbird closed its doors, I would say Sing Sing now on Main Street.
Nice.
Sing Sing, yeah, good choice.
And the obvious follow-up question there, of course, is how do you order your steak now that you've become a steak man?
Well, I was always medium, and now I'm going medium rare, but that's about as far as I go.
Nice, in the right direction.
Yeah.
All right, we'll crack the last of the six-pack here with what is a book that you think all of our listeners should read?
Okay, well, this is just topical, and I just recently read it. So it's called The Bitcoin Standard by Saifedean, and it's like I like it. Kind of explains the history of currencies all the way back from like the Mesopotamian times to now, and it's very topical from kind of the environment we're dealing with, and then it kind of sheds some light on what Bitcoin is. I thought it was really good, and I would recommend it to anybody.
Interesting.
Awesome.
We'll have to check it out.
All right, well, that pretty much wraps things up for us. But before we do, how can people get in touch with you if they want to reach out?
Yeah, they can hit me with email, nclark, NCLARK, @eflcanada.ca, or they can just, give our office a shout, 604-669-9600. Just ask for me, and happy to help.
Awesome. Well, Nigel, that was a lot of fun. Really appreciate you taking the time, and please enjoy your long weekend.
Guys, it was a lot of fun. Thank you.
All right, take care.
Okay, bye.
Bye-bye.
All right, so that was our conversation with Nigel Clark, the Senior Vice President of Construction and Commercial Real Estate at BFL Canada. Lots of good takeaways from that conversation.
Yeah, I haven't listened to the show yet, but I talked to you and Seamus about it a little bit, and both you guys, it sounds like you learned a lot. What were some of the big takeaways?
I mean, there was lots. We talked about the parallels between what's going on just in macroeconomics today. We're talking about inflation, we're talking about rising interest rates, and he talks about the parallels, between the commercial real estate market and the insurance market. One of the things that he touched on were the difference between a soft market and a hard market in the insurance realm, which I don't think a lot of people know about it. Soft market essentially, is better for the consumer. Hard market just means that there's less suppliers and more demand. But it sounds like, we are in a hard market, but it's driving towards more of a soft, hard market, if that makes sense.
Right. So we're seeing some softness coming to the insurance market then. So good news then for people that are looking for insurance.
It sounds like it's headed in the right direction. And yeah, great conversation with Nigel. He's extremely knowledgeable about the industry, and he really went in depth. I think the listeners should really enjoy this episode.
So Rod, we checked in with Corey a couple weeks back just about the market, but are you guys feeling the impact of the increase in the interest rates?
Yeah, we certainly are. I mean, we're definitely not immune to it. There's still lots of activity, but it certainly is changing. And the reality is too, in commercial real estate, when July and August come along, it always slows down anyway. So it's a little bit hard to tell, whether it's the interest rates that are impacting this, or if it's just you've got clients on vacation, you've got brokers on vacation. Lots of people are taking the time, especially after the beginning of the year that we had that was full of rain. Now we've got the heat wave going. So seems like a lot of people are away, and it typically slows down this time of year anyway.
Right. So maybe a time where there might be, if you are looking for opportunities, or if you are thinking about getting into the commercial real estate market, how can people get in touch with you, Rod?
Yeah, me personally. So I always prefer a phone call. You can call me on my cell at 604-763-5510, or also feel free to reach out to me via email, roderick@williamwright.ca.
All right, Rod. Well, thanks for taking the time today, and thanks for filling in the Rod and Seamus show coming soon. All these guys on vacation, Matt on vacation, Corey on vacation. You guys are doing God's work here at home.
Yeah, we really appreciate you having us on.
All right. Take care.
All right. Thanks.
Subscribe today.